Hey everyone, welcome back to Corporate Decoder, the place where we decode the wildest corporate secrets. And today we're diving into Powerlaw Corp's latest shareholder report. Get ready because this one's got some interesting moves in the world of private tech investments. Before we jump in, if you love getting the inside scoop on companies directly from their filings, make sure to hit that subscribe button. And for deeper discussions and to connect with other finance enthusiasts, join our Discord community linked in the description below. Alright, so Powerlaw Corp is basically a fund that aims to make money by investing in promising but still private technology companies, especially those in their later stages of growth. Think of them as venture capitalists looking for the next big thing before it hits the stock market. This report covers their first period of operation from January to September of 2025. And they put a hefty $235 million into 14 different companies. That is a lot of eggs in a few high-tech baskets. The big picture for this kind of investing is that the market for these late-stage private companies actually did better than many expected in 2025. Deals were happening, and investors were particularly interested in companies that were showing real progress, especially in artificial intelligence. Companies focused on AI were attracting bigger investments, about 25% more for Series C rounds, and even more for later stage deals compared to those not in AI. This means there is a growing gap between the superstar companies and those that are struggling to get more funding. Now, when investors talk about getting their money back, that is called exit activity or liquidity. This improved a bit in 2025, but it was still a bit of a mixed bag. There was some initial public offerings, meaning companies went public on the stock market, but it was very selective. Many companies were still opting to raise money privately rather than go public. This is partly because the prices companies got when they did go public were often lower than what they were worth when they were private. So the private market ended up absorbing a lot of the funding needs, including a big increase in secondary transactions, which is when existing investors sell their shares to new investors. Looking ahead to 2026, the outlook is generally positive, especially for AI companies and with private capital still available. But if the public stock market takes a downturn, it could slow things down. Let's talk about some of the companies Powerlaw has invested in. Big names like SpaceX, Anthropic, Stripe, Databricks, and Anduril all had major deals happen after Powerlaw put its money in, and this meant their value went up. That is good news for Powerlaw. Companies like OpenAI, Kraken, XI, Perplexity, and Rippling also had significant deals that happened around the same time or before Powerlaw invested, so these did not change their valuations from Powerlaw's perspective. On the flip side, Colossal Biosciences and Waymo did not have any major deals that would change their valuations. A notable case is Figma, which went public in July 2025. It started strong, but by the end of September, its stock price had fallen. This shows that even public companies can have volatile performance, and it impacts how Powerlaw values its stake. Some of these companies are really showing strong business growth. Databricks, for instance, hit over $4 billion in annual revenue, with their AI products alone bringing in over $1 billion. That is a massive accomplishment. And SpaceX isn't slowing down with its Starlink internet service, now serving over 6 million customers and launching thousands of new satellites. Kraken, the cryptocurrency exchange, also had a fantastic third quarter in 2025. Their revenue more than doubled compared to the previous year, and their profits before certain costs were also very strong. This seems to be driven by more trading activity and people using their platform more. Overall, the report suggests that while these companies are still private and can be hard to sell quickly, many are showing solid business performance like winning big contracts or growing their user base. This business momentum, even while they're private, is a really positive sign for Powerlaw Corporation's strategy. Now, let's dig into the actual numbers, the financial statements. This schedule of investments shows where Powerlaw has put its money. Remember, these are private companies, so valuing them is more of an estimation based on recent deals or how similar public companies are doing. A big chunk of their investments, nearly 12.4% of the total net assets, is in something called FDVC Growth, a -1 LLC. This is a special purpose vehicle, or SPV, which is a way for them to hold investments indirectly. This particular SPV gives them exposure to SpaceX and XII Holdings Corp. That is a significant bet. Another massive investment is in NDH Opportunity Funds LLC, giving them exposure to OpenAI. This holds over 16% of Powerlaw's net assets. Given OpenAI's prominence, it is understandable why this is such a large part of their portfolio. These two SPVs combined make up a huge portion of their holdings, showing a clear focus on these very large, high Profile tech companies. When you add up all their investments, they've put over $346 million into various companies. Most of this is in private companies, with a significant portion also in short-term government debt and money market funds, essentially safe places for their cash. Looking at the types of investments, over 46% are through these SPVs, which is quite high. Short-term government debt makes up another substantial portion, about 24%, providing some stability. This mix shows they are actively investing in private companies, but also maintaining a portion in less risky assets. Industry-wise, US Treasury bills are a significant holding, accounting for about 24%. Then you see a heavy concentration in artificial intelligence, both directly and mixed with aerospace, making up roughly 36% of their investments. Financial technology and software are also key areas. This clearly highlights their strategic focus on cutting-edge technology, particularly AI. Now, let's look at the company's overall financial health. Their total assets are over $417 million. This includes their investments, which are the main driver of their value. They have some liabilities like expenses that need to be paid, totaling about $2.9 million. This difference, the net assets, where their total assets minus liabilities, comes out to be just over $414 million. And on a per share basis, their net asset value is 80 cents. This is important because it is the value of each share of the company. In terms of operations, they had investment income, mostly from interest, totaling about $1.6 million. However, their expenses were much higher, around $5.2 million. This led to a net investment loss before taxes of about negative $3.6 million. Think of this as their operating costs being higher than the immediate income from their investments in this initial period. But here is where it gets interesting. While they lost money on their day-to-day operations, their investments actually grew in value. The net change in unrealized appreciation on investments shows a gain of over $6.4 million. This means the private companies they invested in became more valuable during this period, even if they haven't sold them yet. This gain, combined with the initial investment capital, resulted in an overall increase in net assets from operations. Looking at cash flow, their operating activities used a lot of cash, over $407 million. This makes sense because they were actively investing, buying shares, and making other investments. On the financing side, they brought in over $407 million from capital contributions, meaning investors put money into the fund. So while they spent a lot on investing, they also brought in a huge amount of capital to fund those investments and operations. Now, a critical part of investing in private companies is how you value them. Powerlaw uses a framework that involves a lot of estimation. Since these companies aren't publicly traded, they have to rely on market data from similar companies, recent transactions, and the company's own financial health and growth prospects. This means a good chunk of their investments are considered level 3 assets, which are the hardest to value because they rely heavily on unobservable inputs and management judgment. This table breaks down their investments by how easy they are to value. Over $63 million in investments are considered level 3. That is a significant portion, highlighting the subjective nature of valuing these private stakes. The rest are mostly level 1, like short-term government debt, which is easy to value. This shows that even within those level 3 investments, they've seen gains. For example, the SPVs, which represent their indirect investments in big tech names, have seen a net change in unrealized appreciation of over $6.6 million. This is the core of their growth story. The underlying companies are growing in value. The company has an investment advisory agreement with Acadian CF Manager LLC. Importantly, they are not charging any management fees yet, which is smart because they are just starting and need to get their registration squared away with the CSE. They also list fees from various special purpose vehicles, which is normal in these types of investments. Looking at the team behind the fund, Benjamin Black and Michael Dinsdale are key players. Benjamin Black, as Chief Investment Officer, has a solid background in private equity and a focus on socially responsible investing. Michael Dinsdale, the CEO, brings extensive experience as a CFO for high growth tech companies, having helped scale businesses like Gusto and DocuSign. They both hold significant equity in Powerlaw Corp, aligning their interests with investors. Benjamin Black has a strong track record in private equity and venture capital, with experience in areas like clean energy and social finance. He's clearly got the background to pick promising early-stage companies. Michael Dinsdale's experience as a CFO at major tech firms suggests he knows how to manage finances for rapidly scaling businesses, which is crucial when dealing with private investments and preparing for potential public offerings. His background in securing significant financing is also a huge asset. Interestingly, neither Benjamin Black nor Michael Dinsdale are currently managing any registered investment companies, which are publicly traded funds. They are managing other pooled investment vehicles, which are essentially other private investment funds. This confirms their focus is primarily on the private markets. Now, like any fund manager, they have to deal with potential conflicts of interest. The advisor is managing money for multiple clients, and they need to make sure they are allocating investment opportunities fairly. They have policies in place to try and manage this, but it is something investors always need to be aware of. The fact that they have a code of ethics and require portfolio managers to act in the best interest of clients is good, but understanding how this plays out in practice is key. Both Benjamin Black and Michael Dinsdale have a significant stake in Powerlaw Corp, owning over $1 million worth of equity each. This is a fantastic sign for investors. It shows that the people running the fund are personally invested and believe in its success. When the managers have a lot of their own money on the line, they are typically more motivated to make smart decisions and grow the fund. And finally, the independent auditors, KPMG, have given their stamp of approval. They state that the financial statements present fairly in all material respects the financial position of Powerlaw Corp as of the 30th of September 2025. This is a crucial step in building trust and confidence in the report. So, what is my take on all of this? Powerlaw Corp is in a high-growth, high-risk sector private tech investments, especially in AI. Their strategy of focusing on later-stage private companies seems sound, and the names of the companies they've invested in, like SpaceX and OpenAI, are incredibly impressive. The fact that these companies are growing in value, as shown by the unrealized appreciation, is a very positive sign even though their operational expenses are currently higher than their income. The significant capital raised and the clear alignment of interests from their portfolio managers, who have substantial personal investments in the fund, add to the confidence. However, the valuation of these private companies, especially those categorized as level 3 assets, involves a degree of judgment and uncertainty. This is inherent to venture capital investing. The reliance on special purpose vehicles, while common, means a layer of complexity and indirect ownership to navigate. Their focus on AI and cutting edge technology presents a massive opportunity if these trends continue, but also a risk if the market shifts or if these specific companies falter. Overall, Powerlaw Corp is making bold, focused bets in a dynamic market. The initial operational loss is expected, but the growth in the value of their underlying investments is the key story here. Alright, that is our deep dive into Powerlaw Corp. Shareholder report, what do you think of their strategy and these private tech investments? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate exposures. And seriously, check out our Discord community for more sweet discussions and insider analysis. It is linked in the description. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.